Here to discuss Daniel Yergin, Vice Chairman of S&P Global and author of The New Age, Energy, Climate, and the Clash of Nations. We were just talking in the break about how it's been a very busy year for you, Dan. Let's start domestically, though. As we look at just the directionality of gas prices, quite the about face. There's been some reporting out there that the U.S. may begin refilling its emergency oil reserve if crude dips below $80 a barrel, basically to support the prices to encourage oil producers to continue on their trajectory. What do you make of just the current environment with regard to prices here in the U.S.? And do you think it will continue to fall?
Well, I think there are two things that are driving it. One is price works, so demand is down. In the last couple of months, demand has been down 6 to 8% lower than the same time last year. And the other thing is the new arbiter of oil prices is the Federal Reserve. It's the central bank of oil. And it's what it's signaling on interest rates is certainly permeating the oil market as it is the stock market.
Fears that demand would be crimped if indeed we
because
go into
less economic activity.
With Europe, of course, also very much in focus. And, there's been some progress made on potential government intervention there. The EU wants to cap energy prices, limit consumption, among other policies. Of course, it has to get buy-in from its member nations to do that. What do you make of this type of intervention? Do you think it will work? And how does it change the world order?
Well, I think it's all about caps now. Caps on oil prices, Russian oil, caps on gas prices and power prices in Europe. And it's a very painful situation. Electricity prices as much as 10 times higher than normal. So I think it's inevitable that they're going to do this. And what they're going to try and do is say, well, electricity prices are set by natural gas, but if you're a renewable, you're getting windfall profits, so we're going to take that away. And then they said they're going to ask the oil and gas companies for a solidarity fund to distribute to people. So I think given the degree of economic hardship, it's inevitable, and you just hope that they do it in a sound, prudent way.
Do you think the incentive structure changes for those companies in Europe, though? Do you think they will continue producing at the levels that they're
Well, I think so. I mean, what they were worried about is if they put a cap on natural gas prices themselves, that means that the LNG that's going to Europe, well, maybe go to Asia where they pay a higher price. So they didn't want to disrupt that. So this is the way they're trying to do it. I mean, it's a terrible situation that they were not prepared for, and they're improvising, and that's what they're trying to do with these proposals.
There were some forecasts for Dutch natural gas to actually come way down because storage is so high, and that they would have to pay the piper when storage came down next spring. Does that make sense?
Well, I think they've done a good job on filling storage, and that gets you in a position for winter. But if it's a cold winter, and Russia does what it looks like it's going to do, remember, for Putin, this is an energy war. This is an adjunct to the war in Ukraine. So he's using gas to create economic hardship and political turmoil in Europe. So he's going to continue to do that. The Dutch actually have this field called Groningen. They could start up production, but they've been very reluctant to do that. Because there was environmental opposition to it in the past. But, I mean, right now, if you go down to Houston, you'll find it filled with Europeans trying to find liquefied natural gas that they can buy from the United States.
We just heard from Kayla Tausche regarding the rail strike, or the potential for a rail strike if they don't come to an agreement. What do you think the impact of that would be on commodity prices, especially given just the backdrop of the current inflationary environment we were already experiencing?
Well, I think, first of all, of course, the battle over wages is a sign itself over inflation. And I think that would, it would be another disruption in supply chains, would be back to supply chain disruptions and all the things that does to prices.
Shepard Smith here. Thanks for watching CNBC on YouTube.